Welcome back, everyone. Today it's all about beta. Beta all the time, all day, every day. In our last class, we were very theoretical. We had a very high level discussion of the assumptions that underpin the capital asset pricing model. To recap, we said that some clever economists way back in the 1960s said, let's try to understand how asset prices work. Let's try to understand why the market pays a different price for a different asset. Another way of saying that is we try to understand why some assets offer high returns, some assets offer low returns. And those clever researchers simplified the market. They said, let's imagine we have a perfect capital market. And in that perfect capital market, there are no liquidity constraints. There is no taxation. There is no information differences amongst investors. All investors form the same expectations for volatility, covariances, and expected returns, and everyone can borrow and lend at the risk-free rate of interest. And under this suite of assumptions, the researchers came up with the capital asset pricing model. And it says that the expected return on any asset is the risk-free rate plus some compensation for bearing exposure to only one source of risk, which is systematic risk. And that risk exposure, the second part of the equation, is the product of the asset's beta, that's an asset-specific parameter, and the market risk premium, that's a market-wide parameter, which is the expected return on all risky assets minus the risk-free rate of interest. The reason only systematic risk matters to investors in this world is because they all have the same information. No one can earn returns via their skill in analysing companies, writing research reports, finding out idiosyncratic information, trading off their efforts. And if I can't beat the market by trading off my efforts, the best that I can do as an investor who likes returns and dislikes risk is to mitigate my risk. And that means holding a fully diversified portfolio. What portfolio is fully diversified? The market portfolio of all risky assets. So I'm no longer exposed to any asset-specific risk, only market risk. And if the only risk that I'm actually exposed to is market risk, then that's the only risk which is going to be factored into my decision about how much to pay for an asset. And therefore, only systematic risk is what's going to be factored into my decision for what return I think is fair compensation for bearing risk. Well, that was theory. Today is all about practice. Specifically, what is beta and how are we going to estimate it? So we're going to run through this agenda for class 3. It's only going to be one class covering maybe 2 or 3 videos. We're going to talk about what is beta and then do a specific application in which we define a small market and a large market of more stocks. In a subsequent series of videos, we're going to talk about other parameter inputs, namely the risk-free rate and the market risk premium, as well as limitations of the capital asset pricing model. So today's class is all about beta. I said, well, what is beta? We're going to talk about how it's the covariance of asset returns with market returns, and then we're going to talk about measurement using Excel. And I'm going to have to toggle back and forth between the PowerPoint presentation and Excel, so you'll see a few parts of the presentation where I have to pause the video to switch between screens. Hopefully I can make it as seamless as possible. So what is beta? We have an equation. The beta of asset I is the covariance of returns on asset I with returns on the market portfolio of all risky assets divided by the variance of returns on the portfolio of all risky assets. Now note that we're referring to assets. We're not referring to stocks. Stocks is one type of asset, but we typically estimate beta with regard to stocks. You don't typically talk about in practice the beta of a corporate bond or the beta of a piece of art. And the reason for that is primarily due to measurement. We have other ways of thinking about discount rates for bonds. We think about the yield to maturity. We compare bonds of different risk and look at high yielding bonds and its junk bonds have higher yields to maturities, whereas bonds with A or AA credit ratings have low yields because they're less risky. So we typically apply this equation with regard to stocks, but it wasn't developed just with regards to stocks. It's not a stock equation, it's just its most prevalent application. So we refer to asset I. The market portfolio in theory is all risky assets, but in practice, our proxy for the market portfolio is typically a stock market index. You want to grab as your proxy for the market portfolio a stock market index which is very broad based. So for example, the Dow Jones Industrial Average is not a particularly broad portfolio of stocks. It only has 30 stocks in it, and it has this quirk in that it is a price weighted index. Right? And that means that larger companies by market capitalization are not necessarily carrying greater weight in the index. The weight in the index is determined by the price of the stocks. Whereas the S&P 500, for example, or the S&P 1500 or the Russell 3000, those are market capitalization weighted indices. My preference is the S&P 1500, which is a basket of 1500 liquid stocks trading on in the United States. In other countries, you can have localized market indices and you can have global market indices, also useful proxies for the market. Beta is our measurement of systematic risk. This is risk that can't be eliminated from a portfolio through diversification. That doesn't mean I can't hold a low beta portfolio. It doesn't mean that my portfolio couldn't have zero beta. I can achieve a zero beta portfolio by having portfolio comprised of low beta investments. But systematic risk means that I can't get that low risk just by holding more and more assets. By construction, the market value weighted average beta of all risky assets in that market portfolio is equal to 1. So via the technique we're going to cover today, if you estimated the beta of all the stocks in the S&P 500 and weighted those beta estimates by their relative market capitalization, the weighted average beta across all those 1,500 stocks would be equal to 1 if your proxy for the market portfolio was in fact the S&P 1500 index. So as my simple example, if you had 3 assets with a beta of 0.7, 1.1 and 1.2 and portfolio weights of 30%, 20% and 50%, you would have the portfolio beta of 1.03 that you can see on the screen, which is a weighted average of the individual beta estimates, and the weights are on a relative basis how much money you have invested in each of those assets. It's also useful to know what proportion of a portfolio's risk is comprised of systematic risk. Now, in that theoretical world which underpinned the capital asset pricing model, everyone was fully diversified. But in reality, we're not fully diversified. People typically have an overweight investment in one property, their house or their condo. People typically, if they're holding stocks, have a relatively poorly diversified portfolio compared to holding the entire S&P 1500 index. So it might be useful in some circumstances to know, well, how much of my total portfolio volatility is comprised of the systematic part and the asset-specific part. Now this is useful because the way that you can actually earn very high returns is to deviate from that market portfolio. So if you don't believe that you as a portfolio manager have skill in identifying which investments are cheap or expensive at any given moment compared to a fair value, you should hold an exchange-traded fund that replicates a broad index like the S&P 1500, for example. That's going to minimize your fees, it's going to minimize your total volatility, and minimize your asset-specific risk. You're just going to be exposed to systematic risk. But if you do have skill, or you believe you have skill, if your business model is saying to investors, I'm going to identify assets that are going to do better the S&P 1500, you're an active portfolio manager. And that could be a private equity manager, it could be a manager of listed companies, any sort of active manager. You are trading off how much extra risk you're putting into the portfolio by holding some concentrated portfolio versus how much extra return you might get because you are taking a bet on skill. So if I'm going to hold a portfolio of, say, for example, 50 stocks, because I can believe I can pick the stocks which are going to earn high returns, yes, I'm going to expose myself to additional asset-specific risk, And I would like to know, well, what proportion of my total risk is systematic versus non-systematic? Well, this is the equation we use to do that. The systematic risk portion of the total portfolio risk is equal to the portfolio's beta squared multiplied by the variance of returns on the market portfolio divided by the variance of portfolio returns. That'll give you the percentage of your total portfolio risk comprised of systematic risk. So as an example, suppose you've done some analysis that says your total portfolio variance is 0.09, 30% standard deviation squared. The market standard deviation is 15%, so market portfolio variance is 0.0225. And suppose you estimate your portfolio has a beta of 0.8. Well, under those computations, your portfolio variance that is attributable to systematic risk, that is this numerator in the equation, is 0.0144. The total portfolio risk is going to be equal to 0.09, and therefore the proportion of your portfolio that can be attributable to systematic risk is 16%. And that means that the remaining portfolio risk, which is attributable to diversifiable risk, is going to be 84%. So this portfolio has a particularly high proportion of risk that could be diversified away if you held a broader expansion of assets. So someone holding this portfolio is making a big bet, basically saying, I think I can do better than the market. I'm going to hold a concentrated portfolio, and I'm going to have risk which is double the risk of the market portfolio on a standard deviation basis. And that's primarily due to increased exposure to the risk of individual assets. Beta is a forward-looking measure. Remember that the equation for the capital asset pricing model starts with expected returns. It says that the expected return on any asset is the risk-free rate plus the asset's beta times the market risk premium. And the market risk premium is the expected return on the market minus the risk-free rate. It would be neat if we can look at assets and say, well, what do we think the forward-looking beta is? How much exposure do we think some asset's going to have given future market conditions? But we can't do that. We can't easily measure expectations. But what we can do is measure past returns on traded assets like shares and bonds, and measure what historical relationship shares and bonds have had with our proxy for the market portfolio. So we use past returns to measure beta, and use that estimate of beta as a proxy for the forward-looking beta, which goes into our equation. Now that means we have a problem, because the actual association between asset returns and market returns in the future can be quite different to expectations. Things don't always turn out the way that you expect. Hence, we're doing this video presentation. If things turn out the way we'd expected, we'd be face-to-face in the classroom. But things don't turn out the way that you expect. But it's what we have. So we need to be aware of the limitations of extrapolating from the past. And the key point, which you see in absurdly large red bold font, is that you can't observe the true beta for any asset. We can only make an estimate of beta. Now that's important for you because people in practice, and in particular when students do internships, they form this idea that beta can be estimated with precision. So for example, you need a beta estimate to value McDonald's. So you look at the relationship between McDonald's returns and the S&P 500 returns and say, well, if I estimate beta for McDonald's of 0.8 using that regression, which we're going to talk about in a moment, that's the beta estimate for McDonald's. But that's not true. The McDonald's beta estimate based upon that past information could have been very different with a very small number of returns that occurred at different points in time. The McDonald's share price will have gone up and down depending upon some company-specific events, a food contamination scare or a great marketing campaign which got more people through the door, and depending upon whether the asset price, the share price for McDonald's, went up or down on any given week. Timing with whether the market was up or down in that week is going to influence your beta estimate. If McDonald's made a great marketing campaign, people were surging through the door to get chicken nuggets with a special sauce in a particular week, and market returns were up during that week, that's going to increase your estimate of beta based upon that historical data, because it's going to increase the association between stock returns and market returns in your sample. If McDonald's, in contrast, had an announcement that there was a food contamination scare and the share price fell by 10% in that week, but the share market was up by 10% in that week, that's going to decrease the estimate of beta that you get from McDonald's using that historical information. Now, those events, the great marketing campaign or the food contamination scare, they could have happened at any time. But if they happen to coincide with the market being up or down, that's going to shift around your beta estimates, introducing noise into the analysis. And that means that you can't just look at one company to estimate beta. You've got to look at lots of comparable companies to mitigate that estimation error. So the key point is that even if you want to estimate the beta for one company like McDonald's, you can't just use McDonald's information for that estimate. You still have to compile a suite of comparable firms, other franchise fast food chains, in order to estimate the beta for McDonald's. So in the next presentation, I'm going to take a pause for a moment. We're going to continue on to an application of a small market. This is going to keep the computations manageable. Then we're going to expand that market to many assets to see how you're going to do these beta estimates by regressing stock returns on, say, S&P 1500 returns. Talk soon.